Well, hello everybody, it's Dave Burkus again for more insights from Burkonomics. Today's insight, an economics lesson for growing companies. Catching up from past insights, we've learned that growing companies usually require more working capital during their periods of rapid growth. In past insights, we've calculated the amount of additional capital needed for a business as it grows, and that amount is often surprisingly large. In this insight, we're going to speak of the sources of working capital and the implications to future financial health of your company when making the choice of selecting a financial resource. And surprise, it may not be equity that you seek. Venture or angel finance companies with plenty of working capital sometimes are immune to the working capital needs for some time into their growth. But at some point, it will become kind of clear that the cheapest form of finance is not equity in a growing enterprise. If the equity value of a company is growing at the same rate of the company, say 40% per year, almost any form of debt financing may be preferable as a way of preventing further dilution, issuing additional equity, providing that dilution, and debt financing does not. Well, now we're into the bank lines, and the banks need to be convinced. The problem is that few small growing companies seem to be attractive to most banks or traditional unsecured asset-backed loans. The exception is for those venture-backed companies with a significant cash balance remaining in the bank, which ironically make them the most attractive customers to banks offering loans. Ironically, the term is compensating balances. The banks want to maintain their venture relationships and of course want existing company cash in their banks as collateral for, you guessed it, their loans to the company. The term of art is compensating balances, and certainly using existing cash to leverage new loans makes a company more liquid, but at a price, as the compensating balances cannot be touched and are essentially frozen for the duration of the bank loan. Well, how about asset-based lenders, one class below bank for lending? There are asset-based lenders of every size willing to take more risk and finance the growth of a young company without requiring those compensating balances. Using the company's receivables and inventories as collateral, such lenders are often going to ask for a Uniform Commercial Code, a UCC, filing, protecting their first interest in all the remaining assets of the company, including, unfortunately, intellectual property, the latter being by far the most valuable asset the company usually has to protect. And I beg you to read the loan covenants clearly and carefully. Loan covenants are always required that clearly state how much net equity, minimum current ratio, and other minimum financial requirements must be maintained to be compliant, and state the penalties for non-compliance, which are often severe and often threaten to control or cancel the loan in its entirety if they aren't kept. Know how to calculate qualifying collateral. One of the more important items in a calculation of amounts available to be borrowed is the amount of qualifying collateral, defined usually as the amount of net accounts receivable less than 60 days old after deducting any billing to any government entity, and all receivables from some companies' balances over 60 days old. To this net number, the lender will then apply a percentage from 50 to 80%. As the amounts available for borrowing under the agreement. And there are other lender tricks that add to the true cost. It's important to calculate the true cost of such money. It's typical to charge an interest rate that is higher than normal bank loans for asset-based loans. It's also typical for them to tack on a float period, typically 5 days, sometimes only 2, amounting to additional interest, as if the money paid back is still outstanding for that extra 2 to 5 days, as compensation for the time to clear checks paid into the lender, either from your customers directly, with a lockbox, or by you. A 5-day float increases the actual interest rate by up to an additional 2% over the stated value. And then there is the loan audit fee, often more than $4,000 a year, to pay for the lender's auditor to make sure that the collateral and the company are compliant with the covenants of the loan. Wow. There are even more add-on charges to watch for. Lenders sometimes often charge for loan oversight, calling it a consulting fee, and often make warrants, a promise for later sale of stock at a fixed price, a part of the deal. When calculating the true cost of working capital After adding all of these elements and estimating the value of the warrants and dilution to the shareholders, you may be shocked at the number when expressed as an annual percentage rate. Well, let's go back to loans costing less than dilution of equity. Yet such loans do rise and fall with the need, and is often cheaper than the cost of dilution when issuing additional stock to obtain working capital. These decisions require knowledge by management, help from accountants or attorneys, and an understanding of the state of such relationships that borrowing from asset-based lenders is like entering into a marriage, where the other partner has all the power to ensure the success in the event that anything goes wrong with your original plans. Well, this is just one of over 300 insights from Berkonomics from over the 14 books over time. I'd appreciate it if you'd check Amazon or your local reseller and perhaps buy one or more of my books. This is Dave Berkus, and I'll see you next time.